Bismillah Rahman Rahim. This is the second video on financial statement fraud. In this video, we will talk about the nature of financial statement fraud, the Phar-Mor case of financial statement fraud, and the motivations for financial statement fraud. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us start with the nature of financial statement fraud. Financial statement fraud involves intentional deceit and attempted concealment. Methods of concealment include falsified documentation, including forgery and collusion among management, employees, or third parties. Fraud system symptoms, indicators, or red flags are typically observed rather than the fraud itself. Caution is necessary as fraud symptoms may also result from legitimate factors. Investigators must exercise extreme care in detecting and proving financial statement fraud. The presence of fraud symptoms does not always indicate the existence of fraud, such as unintentional errors or changes in economic factors can also cause fraud symptoms. Caution should be exercised when interpreting reports of alleged fraud, as false allegations may occur. Fraud symptoms cannot be easily ranked or combined into predictive models. The significance of red flags varies widely, and some may be present even in the absence of fraud. Detecting and providing financial statement fraud is challenging, often requiring confessions, obvious forgeries, or patterns of repeated fraudulent behavior. Next, let us talk about Phar-Mor, an example of financial statement fraud. This case highlights the dangers of succumbing to financial pressures. Phar-Mor was founded by Mickey Monas in 1982. Initially, it thrived by offering low price household products and prescription drugs. By 1985, it had 15 stores, and by 1992, there were 310 stores. Phar-Mor's case highlights the dangers of succumbing to financial pressures. The Phar-Mor's strategy was to load up products when suppliers were offering rock bottom prices. However, after 5 to 6 years of success, Phar-Mor began experiencing financial losses. And to maintain the appearance of profitability, Monas and his team resorted to creative accounting practices, including inventory manipulations and overstating income. Investors, including major corporations like Westinghouse and Sears, poured billions into Phar-Mor based on falsified financial statements. Monas and his associate Patrick Finn embezzled millions to support personal ventures. The fraud involved understating expenses and overestimating income, leading to inaccurate financial reporting. The manipulation continued, escalating over time and causing significant financial losses. Internal investigations estimated embezzlement of over $10 million. In 1985 and 86, before the major fraud started, Monas instructed his subordinate Finn to manipulate expenses. Monas wanted to downplay expenses that exceeded the budget and exaggerate those that were under the budget. This made operations appear more efficient. Although these initial manipulations balanced out overall, they distorted the accuracy of the accounting information. Finn later pointed out that Mona's seemingly innocent request laid the groundwork for the extensive fraud that followed. The Phar-Mor financial fraud tactics was um, Finn boosted Phar-Mor's gross profits from 14.2% to 14 to 16.5% by inflating inventory figures. Phar-Mor hired an independent firm to conduct inventory counts in its stores. After receiving the inventory report, far more accountants compiled the data into packets. These packets calculated inventory at cost and journal entries were made accordingly. So instead of debiting cost of goods sold account, they debited bucket account to avoid detection by auditors. At the end of each fiscal year, the balances in these bucket accounts were emptied and allocated to individual stores as inventory. This manipulation made it seem like Phar-Mor was selling products at a higher margin, thereby overstating the net income. Additionally, Phar-Mor pressured vendors to make substantial upfront payments in exchange for exclusivity rights, preventing them from selling competitors' products. Some vendors paid up to 25 million of these rights. Monas used this money to cover hidden losses and pay suppliers. Now, instead of spreading out revenue from these exclusivity payments over the vendor's contract terms as per accounting principles, Monas and Finn recognized all the revenue immediately. This allowed Phar-Mor to showcase impressive financial results in the short term. Financial statement fraud often begins with a company seemingly to outperform others, raising high expectations from investors and analysts. When the company fails to meet these expectations, pressure mounts to maintain the appearance of success. At this juncture, individuals overseeing financial reporting may comprise accounting principles in small ways, initially justifying these actions as beneficial for the company and its stakeholders. Initially, these valuations may seem aggressive but not fraudulent, with the expectation of being corrected later. However, as pressure to meet expectations persists, the manager responsible for the initial violations become the primary source of fraudulent accounting practices. This gradual progression, often termed a trickle to a waterfall, leads to a situation where what began as minor earnings management evolves into a significant financial disaster when eventually detected. Next, let us talk about what motivates or the motivations for financial statement fraud. Now, motivations for financial statement fraud can stem from various factors like supporting high stock prices or offerings. In some cases, the aim is to inflate the stock prices or support the offerings, enhancing the company's financial image. Executives, particularly those holding significant company stock, may manipulate statements to safeguard personal wealth tied to stock performance. Division managers may succumb to pressure to meet unrealistic expectations, resorting to fraudulent practices when faced with failure. The Phar-Mor case illustrates how rapid expansion ambitions led Monas to undercut prices, resulting in substantial losses. Rather than acknowledge these setbacks, Monas concealed them to maintain an illusion of profitability. Despite differing motivations, the outcome of financial fraud remains consistent. Detrimental repercussions for the company, its leaders, and investors, eroding trust and integrity in financial reporting. So this completes the second video on financial statement fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.